Good morning, traders. This is your Forex market commentary brought to you by ECN. Today's commentary, we will touch base on the pound-dollar market. The narrative for the pound-dollar market heading into this week's trading session will likely be tainted by low volatility and lack of risk opportunity that can majorly shift the market expectation on the pound. However, the pound sterling is trading near an inflection point as the support floor of its rising channel comes into focus on the technical front. I hope that this commentary will prove to be insightful for our traders. So moving on, let's touch base on the pound dollar market on the technical front. Here we have the pound dollar on the 1 hour time interval. Volatility is expected to remain muted heading into this week's trading session as the UK and US market are closed for a national holiday on Monday. Therefore, the price action for the pair during today's trading session will likely be trapped in a congestive trading range. Looking over last week's trading session, the pound sterling has certainly had an amazing performance. During last Wednesday trading session, the pound broke out from its 200-day simple moving average on an upbeat UK core and retail print, which beat market consensus. This risk event allowed the pound to rally and test the 1.6900 level before forming the head and shoulder pattern that marked its intra-week top, which was later followed by a correction to the downside. Despite Thursday UK GDP print coming in line with expectation, the data did very little to exhaust the reversal in the intra-week momentum. This price action is mirrored by the RSI, which is commonly known as the momentum oscillator. The pound bullish momentum reversed course when the pair first tested the 1.6900 last week, and as the bear started to overpower the bull, the RSI continued to consolidate below the 50.00 price value. Last week's pound-dollar correction is forcing the pound to test the support floor of its rising multi-month wedge formation. The critical support level is set at the 1.6800 zone. Failure to sustain trading momentum above this level will expose the pair to the second tier of support levels set at 38.2% Fibonacci retracement at 1.6711. Since the pound-dollar pair is trading near its critical support level, its risk and reward profile does not validate short entry at this point. Likewise, in absence of a bullish buyer's risk event, leaves analysts in favor of a neutral position. During the establishment of last week's head and shoulder formation, retail traders were at their most short pound-dollar position at that point. Short net interests were at 7 for every 1 long interest taken up by a retail trader. Price action correction has exhausted this short interest to a current level of 3 short pound-dollar position for every 1 long position outstanding. Analysts are in favor of taking a contrarian standpoint to this crowd sentiment and in favor of near-term sterling strength. Analysis of a collection of technical indicators on the hourly interval on the pound-dollar market suggests a temporary bearish market sentiment. I recommend long positions on the greenback. The hourly chart showed that the single currency opened today's Sydney trading session 1 pip above its established short-term Fibonacci support at 1.6828, while the Fibonacci resistance is set at 1.6838. Last week's sterling correction had forced a pound-dollar cross to briefly break below the 200-day simple moving average, and currently the pair continue to trade within the boundary of the 200 days. Currently, the pair is trading 1 pip above the 200 days. Therefore, the long-term outlook on the pound continue to remain bullish if the trend line continues to trade above the 200 days. This price action holds great significance as 200-day simple moving average contain more or less of 1 year's worth of trading data and the forecast long-term market sentiment. However, this bullish long-term outlook on the pound-dollar pair is not shared by its short-term moving average counterparts, as the pound-dollar pair opened today's Sydney trading session above the 10 but below the 5 and 20-day simple moving average. Collectively, this is indicative of a sell recommendation on the technical front. So let's highlight this week's risk event. Despite the number of major risk events, there are some risk events that can potentially force the pound dollar to break out. So this week on Tuesday, we have the BBA mortgage approval forecast from the UK to come in at 45.2 thousand, while the US will release its core durable goods order month-on-month forecast to come in at 0.3%. On Thursday, the US will release its GDP quarter-on-quarter is forecast to contract by 0.5%, while its US pending home sale month-on-month is forecast to expand by 1%. Wrapping up this week's trading session, on Friday, the US will release its personal spending print month-on-month forecast to expand by 0.2%, while the Michigan consumer sentiment forecast to expand by 82.0%. So now moving on to the fundamental front on the pound-dollar market. The pound-dollar pair has been dubbed as the most bullish currency pair in the FX market, only second to the Kiwi to US dollar. One of the main driving reasons behind the bullish momentum is the expectation for a rate hike in the near future from the BOE. Despite the time frame for a rate hike itself continue to remain unclear. However, when the market has been pricing in for the BOE to hike, its benchmark rate will likely take place in either the first or second quarter of 2015. Supporting this expectation was the recent BOE quarterly inflation report, which does not suggest that the bank would likely to hike rate this year. Take last trading week as an example. An upbeat UK retail sale assisted the intraday pound rally up to the 1.6900 level, based on the expectation that inflation reading can grow in line with retail sales, and that was enough to sustain the market expectation for a rate hike in the medium term. UK core retail sale year-on-year grew at its fastest pace at 7.7%, with expectation forecast of 5.3% reading, while retail sale month-on-month expanded at 1.3%, with the expectation set at 0.8%. Analysts believe that the pound-dollar market medium to long-term price action will continue to oscillate between the 1.700 multi-years resistance level under the condition that market volatility will remain low and risk aversion is not a major threat to this ascending trend channel. The greenback has certainly managed to retrace most of its losses against the pound sterling in the later part of last week's trading session. This was largely supported by new home sales print. Even though the report failed to meet expectation, it grew compared to prior reading. Last week, FOMC official commentary showed the market that the Fed will still lack a collective viewpoint on the time frame of its rate hike. Thus, the period by which tapering will come to completion and the first rate hike had been perceived as being overextended. The transition between loose monetary policy and the Fed's first cycle of tightening is often met by market volatility. However, the suppression of long-term US Treasury yield clearly indicated that the Fed has been doing a tremendously great job in keeping the cost of borrowing low while they begin scaling back its QE program. Greenback price action will continue to remain muted unless there's a fundamental shift in market expectation, and the catalyst that can trigger this is a consistent improvement in US leading economic indicators that can support strong inflation growth. I want to thank everybody for listening and thank you for your time.